Days Payable Outstanding, DPO, is the average time in days that a company takes to pay its bills and invoices to its suppliers, including normal cash purchases. From a cash flow point of view, we want to maximize this. It's common for businesses to buy inventory, rent, or utilities from their suppliers on credit, paying often 30 or 60 days after purchase. This is great for the buyer's cash flow, as delaying when you pay your suppliers minimizes the cash conversion cycle by shortening the time between paying your suppliers to getting paid by your customers. DPO is also sometimes called accounts payable turnover period, days in accounts payable, payable days, accounts payable period, creditor payment period, or trade payable days. So, what impact does days payable outstanding have on our business's cash flow? The longer we have to pay our suppliers, the better for our cash flow, assuming they're not charging us interest, of course. It's effectively an interest-free loan, good debt. A small DPO means we purchase our inventory from our suppliers and then pay for it very soon after, while a negative DPO would mean that we're paying for future deliveries in advance, perhaps to secure a better price on bulk buy. There's an important trade-off here between paying a lower price and the impact on cash flow. To calculate DPO, we take our average accounts payable and divide it by the cost of goods sold in a certain time period, and then multiply by the number of days in that time period. Note that here we use the average accounts payable over the time period we are working with. If we were just to use a snapshot accounts payable just at, say, the end of the month, we would very likely get a figure that doesn't represent the situation. We could choose to use a simple average or perhaps take samples every week or so. Let's look at an example. A toy manufacturer looks at its accounts payable over the month of April and works out that, on average, over the month, its accounts payable was $35,000, and the cost of goods sold in April was $40,000. This means that the manufacturer has a days payable outstanding of $35,000 divided by $40,000 multiplied by 30 days in the month of April, which gives a DPO of 26.25 days. So, our days payable outstanding is a measure of how much money our business owes to our suppliers, our accounts payable, relative to our sales and measured in days. A longer DPO gives a shorter, better cash conversion cycle.